Welcome to the Explainer. Today, we're building an investor's scorecard for AMD's Q1 2026 earnings and SEC filings. And look, this isn't just your standard quarterly update. What we're actually watching is a massive structural pivot happening in real time. AMD is basically transforming right before our eyes from a traditional consumer chipmaker into an absolute enterprise AI infrastructure powerhouse. So, we're going to dig into the numbers, the strategic shifts, and, of course, the underlying risks to get the full picture. Let's get right into it.
Let's start right at the top with the bottom line. AMD pulled in a massive $10.3 billion in first quarter revenue. That is an incredibly impressive 38% year-over-year growth. And what's really fascinating here isn't just the sheer size of that number, it's the velocity. I mean, when a massive company like this accelerates its top-line revenue by almost 40% in just a single year, that tells us a fundamental shift in market demand is actively underway.
CEO Lisa Su actually hit the nail on the head during the earnings call. She said, "These results mark a clear inflection in our growth trajectory and a structural shift in our business." She didn't mince words there. She established right out of the gate that this quarter is a critical threshold. The data center is now officially AMD's primary growth engine, completely overtaking their legacy client and gaming businesses. For us as investors, structural is the magic word here. This isn't just some temporary spike, right? It's a permanent realignment of how and where AMD makes its money.
So here's our roadmap for today's scorecard. We'll start with the Q1 2026 inflection point. Then we'll look at their data center and AI dominance, followed by the newly revised $120 billion CPU market. After that, we'll cover the shifts in gaming, dig into the financials and OpEx, and finally, we'll wrap up with the underlying risks and outlook.
Okay, Section 1, Data Center and AI Dominance, the primary engine.
Let's look at the exact numbers driving this transformation, because frankly, they are staggering. Data center revenue absolutely exploded to a record $5.8 billion. That's a 57% year-over-year surge. This isn't just a bump in the road, it's a tidal wave, and it's being fueled by massive deployments of their Instinct GPUs and EPYC CPUs. Literally every major cloud provider expanded their EPYC footprint this quarter. Think about that. When your primary segment is growing at almost 60%, you basically have to tear up the old financial models and rewrite the growth projections for the entire company.
And this momentum, it's being locked in by some serious mega deals. Take their expanded strategic partnership with Meta, for example. This is an absolute blockbuster. We are talking about securing up to 6 gigawatts of infrastructure. 6 gigawatts! They're co-designing a custom GPU based on the new MI450 architecture, and they're leveraging their Helios rack-scale architecture, which, if you remember, integrates GPUs and CPUs together. Production shipments for this are ramping up in the second half of the year. For investors, this is golden, because it gives us that crucial multi-year visibility into large-scale deployments.
Moving on to Section 2, the $120 billion CPU market, revising the TAM.
So GPUs are getting all the headlines right now, obviously. But why does this AI infrastructure build-out matter so much for AMD's traditional server processor business? Well, the catalyst here is something called Agentic AI. This is a whole new tier of AI workloads. These autonomous systems require substantially more CPU compute to function. They need traditional processors to handle the orchestration, the data movement, and the parallel execution. Essentially, you can't just plug in a million GPUs and call it a day. You actually need highly capable CPUs acting as the head nodes to run those giant GPU clusters. So the AI boom is literally pulling the CPU market up right along with it.
Because of this fundamental shift in compute requirements, management just radically revised their total addressable market projection. And this is huge. Previously, they had outlined a historical growth rate of about 18% for server CPUs. Now, they are projecting a massive 35% compound annual growth rate, expecting the market to reach over $120 billion by 2030. To put that into perspective, an expansion of this magnitude completely changes the long-term earnings potential of the stock. It's a real game changer.
Now, how are they actually going to capture this newly expanded $120 billion market? Well, AMD is launching their 6th-gen EPYC processor, codenamed Venice. It's built on their Zen 6 architecture and a 2-nanometer process. Management was very explicit here. They stated this chip promises more than double the throughput of leading ARM-based AI solutions. The strategy couldn't be clearer. They want to provide the absolute highest performance head node to orchestrate the entire AI revolution.
All right, let's pivot to Section 3, Gaming and Client Segment Shifts, the bear case.
Look, to maintain a truly balanced investor scorecard,
we can't just talk about the tailwinds. We have to look at the notable headwinds facing AMD's legacy segments too. Because while the data center is soaring, the gaming segment is genuinely struggling. Sure, they had an 11% year-over-year bump this quarter, but the future looks pretty tough. Management is now actually projecting a greater than 20% revenue decline in the gaming segment for the second half of the year compared to the first half. That is a steep sequential drop, and it's something investors absolutely must factor into their near-term modeling.
So the million-dollar question is, why is this drop happening? The company directly attributes this steep decline to rising memory and component costs. This is putting heavy pressure on the consumer-focused gaming market and basically suppressing demand for standard graphics cards and semi-custom chips. It's a harsh reminder that while enterprise tech is having a massive boom right now, the consumer hardware market is still highly sensitive to macroeconomic input costs.
Which brings us to Section 4, Financials, Margins, and OpEx.
With such a stark contrast between a booming enterprise segment and a shrinking consumer segment, it's vital we track how AMD is aggressively deploying its capital. Unsurprisingly, a major question from analysts on the earnings call was specifically about operating expenses. Basically, where is all the money going, and how are these expenses being managed amidst this rapid, frankly unprecedented, scale-up of the AI business?
CFO Jean Hu provided a very clear framework for their capital allocation here. She explicitly noted that research and development spending is going to significantly outpace selling, general, and administrative expenses. They are leaning in hard to engineer the next generation of AI hardware. They clearly view this as a critical race that they absolutely have to win. Meanwhile, their SG&A spend isn't just a broad spray of cash, it's highly targeted. They're focusing specifically on enterprise servers and commercial PCs, particularly targeting the mid-market and SMBs, areas where historically AMD hasn't invested quite as heavily.
And finally, Section 5, Investment Risks and Outlook.
Let's look past the optimistic earnings call for a second and dig into the literal risk disclosures found in their newly filed 10-K, because this is where you find the real fine print. There's a fascinating detail in there that highlights their exposure to macroeconomic forces. AMD warns that a mere 50 basis point shift, we're talking just half a percentage point in interest rates, could swing the fair value of their cash and investment portfolio by $25 million. It just goes to show you that even a massive tech giant riding a historic AI supercycle is not immune to the gravitational pull of federal interest rate policies.
Furthermore, their strategic investments carry some serious weight. AMD invests pretty heavily in early-stage private tech companies to support their strategic initiatives. But the catch is, these are largely illiquid and highly susceptible to market volatility. They explicitly warn of sector concentration vulnerability in the 10-K, meaning if the specific tech sectors they invest in experience a downturn, it could force AMD to recognize impairments and potentially lose all or part of those investments. It's a calculated risk, for sure, but it's what they feel they need to do to stay at the cutting edge.
Yet, even when you factor in the consumer gaming drop and those disclosed portfolio risks, the momentum right now is just undeniable. Management left investors with a very bold projection, a clear path to exceeding $20 in long-term earnings per share. When you look at the structural shift to the data center, that massively expanded CPU TAM, and the scale of mega deals with companies like Meta, it leaves us with one incredibly provocative question. Despite the unbelievable growth we've already seen, is AMD's AI infrastructure supercycle truly just beginning? Thanks for joining me on this explainer. I hope this scorecard helps you navigate the market ahead.